How's it going? Today I want to talk to you guys about tax efficient investing. And this isn't going to matter to a lot of people because a lot of people don't get to a point where this really matters to them. If you're just investing in an RRSP or a TFSA, these rules don't really apply. It doesn't matter how you're invested because it's all taxed the same or not taxed at all at the end of the day. But for wealthy Canadians or business owners that have exhausted their RSPs and TFSAs, they're either going to have to invest inside of a non-registered investment account that's personally owned or in a corporate account inside their holding company or their corporation. And it's really important to understand that it almost matters more in this case about how your investments are taxed more than how much they actually grow, because some investments can be taxed up to twice as much as others, so you're going to get kind of burnt. So I'm going to give you a quick example just to sort of explain in the basic terms, and then I'm going to show you two ways that I'm going to talk about how you can invest tax efficiently. So let's say you just have $1 million non-registered portfolio, you own it, and 1 year you make 10%. You make $100,000 and your marginal tax rate in that year is 50% because you're a wealthy Canadian. So if all of that $100,000 that you made was from interest-bearing sources like GICs, bonds, whatever savings accounts, you're not going to get 10% in this market. But let's say you did, all of that income, all of that $100,000 is going to be completely taxed that year. So after you pay the 50% tax, you're only going to be left with $50,000. But if you took another option and you said, okay, I'm just going to buy Apple stock, for example, and you made $100,000 in the year, if you didn't sell, you are allowed to keep growing it. Well, let's say you did sell all of those gains. Well, now you're only going to be taxed $25,000 because you're only taxed on half of what you made instead of 100% of what you made. And in the same case, if you made $100,000 in dividends, you'd probably be taxed about $32,000. So as you can see, it's really important. You have so much more money. Now, that's an easy case for me to say, okay, well, you should just invest more aggressively if your accounts are in non-registered accounts. If you're investing in non-registered accounts, then you need to invest more aggressively. But truth be told, most wealthy investors that I ever meet don't exactly want to take huge risks with their money unless they actually have some control over it. They don't want to risk losing their nest egg by trying to make a few extra bucks, so then they worry more about their risk tolerance than the actual tax efficiency of it. And the other thing is that a normal portfolio is generally going to consist of a lot of different things. So you're going to have some stocks, you're going to have some bonds, you're going to have some companies, own some stocks and companies that produce dividends, so you're going to be taxed on all these different sources. So it's a lot easier said than done to just do that. So there are a couple ways to do this, and there's another way to do this inside of an insurance policy, but I don't want to get into that today. I think that's for a more specific set of circumstances and goals for your future, but there you can invest tax efficiently inside of an insurance policy. It can be done. So there's two ways I'm going to talk about today. The first is something that's called tax loss harvesting. It's something that you can do if you're invested in index tracking ETFs. It kind of has to work like that, so you can buy and sell pretty much the identical thing. That's a different product. So you first have to understand, and I mean, I'm sure if you're in this case, you do understand this, that if you lose money on an investment, so if you bought $100,000 worth of Apple stock again, and it dropped $20,000 and then you sold, well, now you're going to have a $20,000 capital loss that you can carry forward. So the next time that you make $20,000 investing in the stock market and owe a $20,000 capital gain, well, they just cancel each other out and you get to carry those forward basically indefinitely. So what tax loss harvesting does is, let's just say you owned $100,000 in a US Vanguard index fund and $100,000 in some Canadian tracking fund, and the US fund went down to $90,000, and in some miracle world the Canadian fund went up $20,000 in that year, had a 20% gain. Well, what the manager is going to do at that time is they're going to sell the American fund to realize the $10,000 loss, and then they're going to buy like basically the identical ETF just owned by a different company, say iShares or something. Now they've triggered a $10,000 loss, and what the manager is going to do on the other side is they're going to want to now rebalance this portfolio because it's too heavily weighted in the Canadian stuff. So when they sell off 10,000 of the Canadian stuff to buy more American stuff, you don't actually trigger a capital gain. So, well, you do, but it gets canceled out. So it's not perfect because it now resets your adjusted cost base on the American fund at $90,000 where it used to be $100,000, but it is a way to reduce your tax bill in certain years and can make your portfolio more efficient. And the next is something that I'm going to call corporate class mutual funds or pools. And this is one argument where I can actually say, you know, it does and can make sense, in my opinion, to actually pay a little bit more for your investments in this case because they are so potentially so much more tax efficient. So all this really is a giant pool of money, just like any mutual fund, but it's set up like a corporation. So the fund manager can trade and do all of these things inside of this portfolio. It can own a whole bunch of bonds, stocks, dividend producing stocks, all sorts of other different kinds of investments. And this is just sort of going to grow tax deferred, kind of like in your RSP, hopefully like in your RSP. And then when you actually sell, you start taking money out of this portfolio, the growth is going to be taxed as a capital gain instead of a mix of dividend income, interest-bearing income, and capital gains income. So you have a smaller tax bill at the end of the day, plus you are still able to invest and have the tax-deferred growth. One thing to keep in mind with corporate class pools and funds is that there is a chance that they will have to issue distributions, which means it could trigger a taxable event in a year where you potentially really don't want that to happen. So there can be drawbacks, but I do believe in that strategy for sure. I think it's really important for people to focus a lot on tax planning and retirement and building up to retirement, because actually controlling your tax is something that we can do for sure. Whereas we don't know what returns you're going to get, but controlling tax can allow your money to last way longer, reduce your tax bill. Obviously, people like doing that. And thank you very much for watching. If you haven't already, please hit the subscribe button.